Ladies and gentlemen, welcome to the final session of today's conference, and thank you for staying this long. Our guests for this final session need no introduction, but that's not going to stop me. Martin Wolf is the chief economics commentator for the Financial Times and the person many of us turn to on a Wednesday to understand what's going on in the global economy. He's an award-winning journalist, a multi-award-winning journalist, and was awarded the CBE for services to financial journalism in 2000. His most recent book was The Shifts and the Shocks: What We Have Learned and Still Have Yet to Learn from the Financial Crisis, a brilliant analysis of what went wrong in 2008 and what in many cases has still not been put right. Professor Mariana Mazzucato is Professor of the Economics of Innovation and Public Value at University College London and Director of the UCL Institute for Innovation and Public Purpose, which she founded earlier this year. As well as being an academic economist, she advises governments around the world on innovation-led growth. Her most recent books are The Entrepreneurial State, Debunking Public versus Private Sector Myths, which came out in 2013, Rethinking Capitalism, Economics and Policy for Sustainable and Inclusive Growth, which came out last year, and a new book published next year entitled The Value of Everything. Welcome to you both, and thank you very much for coming. I'd like to start, if I may, with the interim report of the Commission on Economic Justice. As we've been hearing today, this report makes two big claims. The first is that beneath the headline figures, and never mind Brexit, the British economy is fundamentally structurally weak in investment, in productivity, in trade, in regional geographic imbalances, and above all now in earnings. And secondly, that to deal with these structural weaknesses, we now need, and have needed since the financial crisis a decade ago, a fundamental reform of economic policy on the magnitude that we last saw in the 1940s, when the laissez-faire economics of the 1930s changed to be a Keynesian policy, and then again in the 1980s when that Keynesian post-war settlement was again changed into the free market, or sometimes called neoliberal settlement, established in the 1980s. So I wanted to ask your views on this. Perhaps, Martin, we could start with you and this analysis of the condition of the British economy. How far do you share the Commission's analysis?
So I actually, along with the other things I was doing today, writing a column, doing a presentation, reread the whole report. So it's reasonably fresh in my mind. I think one can always quibble with details, but it seems to me that the report gives a pretty good account of the current state of the British economy. So just to underline the things which seem to me most central in thinking about where we are, and particularly the things which, as it were, are most surprising in the sense that they're not what many people expected 15 years ago, and therefore most demand a change in policy. I think probably the single most surprising thing has been the complete collapse of productivity growth. We'll come to these things that are not so surprising because they were there already. Interestingly, up to 2007, the measured data, and I would stress I'm sure Mariana will say more about it, the difficulty in measuring productivity, which is ultimately the difficulty of measuring GDP. But nonetheless, comparable statistics tell you a little bit about how we're doing it relative to other countries. And up to 2007, from the mid-80s, our productivity performance seemed among the better performances in the G7, among the major industrial countries, up there with the US, and the bottom was Italy, and the others were in between. And since then, we've been with Italy, actually even worse. So the point is that our productivity performance on all the measures has deteriorated more than that of any other major economy, from what seemed relatively good to zero. That's a big surprise, and by now it's pretty obvious it isn't a blip. It isn't. So that, I think, is the single most stunning surprise. And it's, of course, I'm with Paul Krugman on this. Productivity isn't everything, but it's almost everything. Of course, distribution matters, but in the long run, the principal determinant of standards of living is the single most important is levels of productivity. So I think you've identified that as a central issue. It's obviously one of Mariana's focal point, and I think it's unbelievably important. The second thing is a surprise in the slightly opposite direction. So I'm thinking, and which you link in very well in the report, which is given how terrible aggregate growth has been, and given, because it's been terrible, as you point out, employment performance, at least on the measured outcomes, has been much better than I would have expected. And you discuss, I think, very well, quite lucidly, how that has worked and what the costs of it been. But we have to recognize that the number, and here we have had an astonishing divergence from the US. So I often compare us with the US. The US has had an absolutely terrible employment performance as well as all the other things, much better in productivity performance. So those are the two big surprises. Let me just say that most of the other things we know about the UK economy, very large regional inequalities, relatively high inequality, relatively low quality of the labour force overall, quite a number, the regional problem, I don't know whether I've mentioned it, are problems with which we've been familiar for a very long time. They've just seemed to now be more serious. So the two things I've mentioned are the most important. Perhaps the final thing is in a policy point of view. I was really surprised, though I shouldn't have been, and I fought very hard against this, completely unsuccessfully, at the fiscal monetary policy mix we ended up choosing, which struck me as wildly irrational, and I've been arguing against this for years and failed completely. So that was a policy surprise. So very briefly, not as briefly as you would like, but as briefly as I can do, this is where I think we are on this report and what I think about it.
So I'd like to come back to the fiscal and monetary policy in a second.
Of course.
But I wanted to widen it out, Mariana, because you write about not just the British economy, but the global economy. And although some of these things are very British, some of them are actually shared in common with other developed economies. So some of these things are things which all capitalist developed countries are now experiencing, aren't they?
Well, not all, but first just one quick parenthesis on the British economy, because I know you think this, but you don't say it loud enough, which is that it has been growing through consumption-led growth, and this consumption has been fueled by debt. So the private debt over disposable income ratio is back to what it was just before the financial crisis. And the financial crisis was caused by private debt, not public debt. And this seems to not be raising as many alarm bells as it should. So then the big question is, what should be happening? And so to transform an economy like the British one from consumption-led to investment-led is the big sort of transformative challenge. And I think later on we'll probably get to the whole issue of investment having not just a rate but a direction and kind of a green direction to investment. Again, I'm sure we'll get to that later. But before we do that, coming back to the bigger global problem, which is this kind of inertial level of investment, some people kind of look at that almost through deterministic lenses of kind of secular stagnation and things like that, which again, I think will be a term we come to later. But I want to argue that one of the key drivers of this lack of investment has also been a really kind of lame deal between business and governments. You used to have quite a bit of reinvestment of profits back into the economy as, in some ways, conditional upon, that when businesses got, whether it was a subsidy or some sort of investment or a monopoly power, like AT&T had a very long monopoly in telecoms, the US government at the time was quite confident and basically forced AT&T to reinvest those profits back into the real economy, back into innovation, and back into big innovation besides telecoms. And this increasing kind of vocabulary that you hear even from the Labour Party, I remember when after they lost the last election, the analysis was, we weren't business friendly enough. That is part of the problem. Business doesn't need to be friendly with. We need sort of a tense, interesting relationship between public policy and the financial world and the business world, and this kind of reduction of that tension and having so much of the show being run by particular lobbies and particular forms of capitalism, because we shouldn't forget there's varieties of capitalism, is a key problem. So one of the issues that came after the crisis, and Brexit has sort of changed this with some of the coming back of industrial strategy, this notion that we have to rebalance the economy away from sort of big bad finance towards good industry misses this point that I've been making, which is that industry itself, business in IT, in pharmaceuticals, and in energy has become ultra financialized. Profits are not going back into the system. So who gets hurt? I mean, the obvious people that get hurt are the workers working in those companies, because skills don't come as manna from heaven, but they are they are endogenously created from investment. So this whole kind of big debate globally that the robots are taking our jobs is simply not true. Robots, sorry, just last point, robots and mechanization have been around for like 200 years. So David Ricardo already in the 1820s was saying, oh, we're screwed. All this mechanization from the Industrial Revolution is taking away jobs. But then what you had was 200 years of jobs perhaps disappearing here because of mechanization, but then showing up again here because profits were being reinvested. That problem, that we don't have this reinvestment of profits back into the real economy, we have finance serving finance and big business using their profits for things like share buybacks, I would call the global cancer today. And it's not just British.
I'd like to come back to the question of the technological changes. One of the phenomena that you've identified that's going on that isn't just British is the glut of corporate savings. So in Britain, we discovered when we were doing our report, British companies are now net savers in the economy, which historically is an oddity, because in many ways the point of a company is to take other people's money, borrow it, and then invest it and make profits and generate growth. And British companies are now net savers. And in fact, globally, there is this kind of glut of corporate saving. Mm-hmm. And this has led some commentators, Martin, most notably Larry Summers, the former US Treasury Secretary, to say we're in an age of secular stagnation, where the argument is that this glut of corporate saving, combined with a decline in apparently the productivity-inducing technological change that we've seen in the past, is leading to a situation where you can't get growth, good growth, full employment at positive interest rates. And that's why we've got negative real interest rates, we've got rock bottom interest rates, and we've got quantitative easing. And these people say we're not going to see an end to that anytime soon, because this is a fundamentally changed kind of global economy. Do you buy any of that?
I would say, though Larry, of course, would disagree, that I got there long before him. So I started writing about this in the early 2000s. I suppose the best known discussion of this before Larry, though Larry always has this genius for finding the right phrase, and don't take it away from him. None of us thought of going back to Alvin Hansen. I mean, that seemed, we should have.
So the first, Alvin Hansen used it in the 1930s.
Yes, yes. This was the phrase used in the 1930s. And of course, it died for pretty obvious reasons, because after the Second World War, we had the biggest boom in investment the West has ever seen, and the fastest growth. And Mariana will claim, well, let her, Mariana claim whatever she wants to claim. Sorry, I apologize for that. So, Bernanke called it the savings glut. I think we could just as well and probably better call it the investment dearth, which would fit in with Mariana's point. I think we can distinguish two questions, and I'll just address the first. The first question is, what is going on? And the second question is, will it be easy to change? I think we might have a lively difference on the second. So what is going on is a combination of things, of which one is what you mentioned. But it's not the only one, which is there has clearly, without the slightest doubt, and there's been a lot of literature on this, which I don't need to go into, been a shift of income from wages to profits, which is just another way. Retained earnings are corporate savings, right? So undistributed profits are corporate savings. Corporate savings have always been gross, the biggest savings in advanced capitalist economies for well over 100 years. And that shift raised, therefore, the savings rate ex ante of the private sector. And it wasn't matched basically anywhere in the developed world by a comparable rise in investment. Okay? The countries which, interestingly, we should stress this, have the far and away the biggest corporate surpluses are neither us nor the US, but Germany and Japan. They are really big, close to 10% of GDP, 8 to 10% of GDP. In fact, the underinvestment of Germany is a particularly striking phenomenon. So we had a very large shift to corporate savings, profits, corporate savings, and investment didn't rise comparably anywhere, and basically every corporate major corporate sector in the world went into surplus. That's one important thing. Two, one other thing happened, which has more or less remained, though not to the same degree, which was very surprising, is that the emerging world went into surplus as well. So the emerging world as a whole, which is obviously mainly Asia, and above all China, became a huge capital exporter as well. That was an enormous surprise to everyone because China had the biggest investment boom in the history of the world and it still had surplus savings. I won't go into the structure of China's corporate savings, but a lot of that too has to do with shifts of income towards corporates. And this basically because China has the highest savings rate in the history of the world, and it's a very big country. The third thing that happened, Mariana's discussed, is a weakening of corporate investment pretty well everywhere in the West. Now, I don't think this was just because of lousy institutions. We can have a much longer discussion of this. I think it's a natural, to some degree, a natural consequence of two things. One, we are relatively slow-growing economies, so replacing a lot of our capital stock doesn't make much sense for the businesses of our country. And second, we have had a very large shift in the structure of our economy towards industries which are remarkably short in the direct need for physical capital. So I've just been writing about this today, and these figures are fresh in my mind, and they are literally unbelievable to me. I discovered, because these are the most egregious, take Apple, the most valuable company in the world right now. Well, Apple's 1 year corporate profits, 1 year, are 40% bigger than its total fixed capital. All the fixed capital it has ever accumulated, it will cover in about 8 months of profits. So it's become an investment fund, as you point out. The same is basically true of, not of Amazon, but of a number of the other companies. And I think that's structural. So if Mariana wants to change that, we have to take all that money away, I discuss how you might do it, and use it somewhere else. The final point to make on this, with corporates becoming net lenders, net savers, which means net lenders, as they did pretty well universally, and the Chinese and other emerging countries also becoming net lenders, somebody had to be a net borrower. Prior to the crisis, and this was all the stuff I was writing about before the crisis, is a bit that I got, the net borrowers were basically the households of a rather limited number of developed countries. UK was important, the US was important, Spain was massively important. It was actually the second most important. And then after the crisis, of course, it became the governments. When the governments stopped lending because they started all going to austerity, that's why we ended up in these ultra-easy monetary policies to push debt. So these things are all linked. The only difference, I think, that's the analysis of what actually happened. I don't think we can disagree on that. Then the question is, how easy is it to fix that in a growth-promoting way? That's a very big and deep question, but the analysis, I think, of what happened is reasonably clear.
So I want you to get on to what we should do about it. Just on this point, so the argument here is that we've got corporate, as you say, big companies become investment funds. Yep. They're saving. That means that they're not investing.
Correct.
You're an innovation economist, Mariana. Innovation needs investment, and it needs it of a particular kind. Mm-hmm. There is something, however, of a paradox that appears, and I wanted to, because every day we read about fantastic technological advances. Artificial intelligence, self-driving vehicles, gene editing therapies. Google seems to be investing in everything. How is it possible that we have that, and yet we also have globally this sense that, in fact, there isn't enough investment in your argument? What's the paradox there, or is it not?
Well, I think if you unpick that, you'd find many different things. I mean, even the R&D spending in many countries is very skewed towards particular companies or sectors. So Google might be investing a lot, but many American companies are not. Google, by the way, is quite functional in terms of reinvesting its profits back, much more than Microsoft and Apple. Apple under Steve Jobs reinvested almost everything, almost zero share buybacks. Share buybacks are when you buy back your own shares to boost stock prices, stock options, and surprise, surprise, executive pay. There's reasons for them sometimes, and I'll mention that perhaps later, but under Tim Cook, this is their big plan. So companies also change over time. Leadership does matter. Within sectors, there's huge differences. Within telecoms, you have #1 in the world, Huawei. Very innovative company, actually. It's a cooperative. It's not a state-owned enterprise. It's actually a Chinese cooperative. There are Chinese state-owned enterprises. You have Ericsson, which I would classify as basically following a more stakeholder value governance structure. And you have Cisco, which is one of the most ultra-financialized companies where more than 110% of its net income is spent in a combination of dividend payouts and buybacks. And so there's choices to be made in both public and private institutions. And the reason that I don't like the term, and some analyses, I like your analysis of secular stagnation, but not of some others that I've heard, is that it kind of makes you feel like this is all inevitable and it's due to interest rates and things like that. But then as soon as you look at a sector or different types of public programs across countries, you see all these different choices. So the fact that actually consciousness, strategic direction, choices matter is actually the optimistic side of all this. It doesn't have to be how it is. And when you actually talk to some of the biggest share buybackers, those companies spending the most on not reinvesting their profits, and these are basically mainly in energy, so like Exxon, in pharmaceuticals, Pfizer, no problem in naming the companies, they often say, oh, there's no opportunities. And it's like, really? There's no opportunities in renewable energy? There's no opportunities in life sciences? Or is it that you've actually chosen to go sort of down that path? And so what to do, I think what's very important is twofold. First of all, we do need to definancialize the economy by rewarding certain types of business and corporate behavior over others. So if we want to reward long-termism, there's all sorts of things you can do to the tax structure, but you can also reward those companies that are reinvesting their profits in order, by making them more easily, accessible to certain types of public funds. For example, in the US, the National Institutes of Health every year spend more than $30 billion just in pharmaceuticals and biotech, and there's no reason that those companies that are not then plowing back their profits back into R&D and human capital, et cetera, should be able to access that kind of taxpayer-funded support just as much as those that are actually, doing the right thing, if you want. And what is doing the right thing? Spending on human capital formation, training programs, R&D, et cetera. But I can't remember where I was getting to. But oh yeah, sorry. And then in this whole thing about, well, then let's invest. We need both public and private to invest because of this dearth of investment. We shouldn't forget that investment has not just a rate, but a direction. And one of the lessons we really see when we look back at history is that private business investment often gets, I don't like this word, but crowded in. I don't like it because it sounds bad, but it's supposed to be good. Crowded in meaning gets excited and actually increases its investment after it sees a business opportunity. So you don't just reduce the tax, whether it's corporate income tax or capital gains tax or a tax incentive for a business to make them invest. If you do that, their profits go up and they might just spend that golfing or something else. If you actually want to make them increase their investment, you need sort of bold, ambitious, what I call mission-oriented policies, which kind of lay the foundations for new opportunities. And that actually gets business to think, oh, wow, there's a growth opportunity there. I will increase my investment. And then to increase the marginal rate of that investment, you could apply kind of icing on the cake through some sort of tax incentive. But what we've seen in the last 20 years is an over-reliance on different types of public tax incentives, which cost a lot of public money. Deficits go up when you have badly designed tax incentives just as much as deficits might go up when you have sort of an ambitious infrastructure or innovation program. And so this whole issue of which are the right instruments, what is the right combination of direct and indirect policies, but especially how do we actually do this in a mission-oriented way so we actually come up with an idea like a green transformation or 21st century healthcare, which then creates new opportunities, which gets business to invest and then also gets rewarded for these long-term investments. And yet we're almost doing the opposite. And to be honest, the mistakes that have happened in the policy area have been equally on the labor side as on the Tory side in this country. I often say, or remind people, it was labor that reduced the time that private equity has to be invested in order to get a massive capital gains tax reduction from 10 years to 2 years. So they made, finance even more short-termist than it is. So this kind of lack of understanding of what really drives venture capital investment and real investment in the economy also creates really problematic policies that increase profits. And as we've both told you, there's no profits problem, there's an investment problem. So how to create additionality, which means getting business to do what it wouldn't have done anyway, is actually a pretty complex process that requires design thinking in terms of what policies we actually construct.
Martin, did you want to come back on
Just
that?
one point, because it might be a difference of opinion. It probably is, and at least it raises a slightly different way. If I understood what Mariana was saying, she was implying that it would be a very good thing that all these incredibly profitable companies, instead of distributing cash to shareholders, were investing more. Investing more in their own business might or might not make sense. My reading of the history of the developed economies is that making existing incumbents, which enjoy supernormal profits on their past activities, invest heavily in new activities is quite likely to lead to chronic waste. And I'm going to give many examples, but one of the best examples, because I followed it fairly closely because I've been around a long time, was in the late 70s when the oil companies were making fortunes and they thought the oil business was going to decline. They all went into all sorts of other energy-related activities. Mariana mentioned renewable energy. I don't want Exxon to get into renewable energy. I think they'll screw it up completely. And I'm not sure that I want Apple to do all these other things. I know what Apple can do well. Why should it do something else very well? So an alternative way of thinking, at least if I may, as I said, I may understand, is to say, okay, Apple has supernormal profits. That is clear by any standards. It doesn't obviously know how to invest it in the business. That's probably quite realistic. Looking at what its business is, what would it invest in? As I said, it could triple its fixed capital and it would still only absorb 2 years of profits. So having Apple distribute the earnings somewhere else, it could be through taxation. Corporate taxation is clearly too low, not too high. I'll make this argument forever. So we've gone in the wrong direction on that. It could be through other means. But we actually, I think, need to cycle the surplus profits of existing incumbents into activities elsewhere. Now, AT&T was an exceptionally good business in this regard. Maybe Google is. But quite apart from my concern that they won't do it efficiently, to my mind, Apple and all the rest of them are quite big and powerful enough already, and I really don't want them to get bigger and more powerful. So I think we should really be thinking not about how we get them to invest more, but how we get the system to invest more and actually getting the money out of them.
Can I just, I'm sure you have another question.
We may not disagree.
Very short, come back on this and then ask me a proper question. I sort of agree with you, but again, look at the heterogeneity. Unilever is completely different. It's a huge, massive company. It's actually doing really interesting things in its space. It's not a perfect company. To equal-sized companies, whether it's in the same sector or another sector. There's huge differences in how these large companies behave. And to be honest, most of the cute little SMEs that even policymakers love to talk about and put a lot of money towards. This country spends $9 billion a year on SMEs, more than we spend on universities. Most of them are not very innovative, not very productive, don't even treat their workers very well if you look at what's happening in many SMEs. Some of them do. There's about 4 or 5% of SMEs that we should really be supporting in these new areas. But the same thing I would argue with the large companies. There are some that are really interesting both to study from a strategic management side, but also to support in terms of the kind of things they're doing. There's all sorts of literature on how you rejuvenate the mature corporation. There's problems with large bureaucratic organizations, which you're kind of alluding to, as well as, anyway, I would just want to say, I think it's too easy to talk about the sort of large incumbents versus the new guys. It's more within each category. We need to be supporting the kind of long-term and visionary out-of-the-box thinking.
In your work, Mariana, you've you've talked about patient capital and the need for much longer-term finance, and that's an issue which we've heard talk about during the conversation today on industrial strategy. And you argue that there's a role for state investment banks, and you point to the fact that other countries, such as Germany, have very successful state investment banks. This suggests a very different role for the state in the economic system. And I wonder whether you could just say something about that and whether that is reflective of the fundamental shift that we've been talking about in the Commission report. Is your interest in that field and your feeling that the private financial system is not generating patient capital of the right kind, does that mean that we really do need a fundamentally different kind of system and with a different role for the state, or is that, in fact, just the same old capitalism, it's just not the British form?
So I think there's a couple issues. One is that, for the most part, the private financial sector has never been very long-termist, and that's not necessarily the question of how you get the private financial sector to become more long-termist. You just have to make sure you're not rewarding them for being short-termist. But at the same time, there were banks like Chemical Bank that was actually called Chemical Bank because it was, at the time when it was founded, actually fueling something in the economy which actually had to do with investment in that particular sector. But the bigger point is that if you look at the few countries, and again, there's few regions and few cities increasingly in countries which are growing through innovation-led growth, and again, there's few examples and they really need to be studied properly. There have been different types of patient, strategic, committed, kind of mission-oriented finance that have been made available. Sometimes it's through a public bank. Sometimes it's through other types of funding schemes. So in Israel, they have a public venture capital fund called Yozma. Very interesting. It's actually been able to attract some of the top investors who were happy and honored to become civil servants for doing what actually also very much enabled their startup nation. And these are actually pretty innovative startups. But, and in some countries, it's happened through public banks. So in Germany, the KfW continues to be incredibly important to providing the patient finance to small, medium, and large companies that are willing to transform themselves. And this whole additionality issue, I want to come back to it, because you don't set up a public bank to help inertial companies remain inertial, to help dying sectors stay alive when perhaps they should die. You set them up to actually achieve certain missions that the government might have because it's a public bank. It's a public bank that should actually be focused on public value. And recently, what's very interesting in Germany is that the KfW, in kind of redirecting finance towards the Energiewende policy, that wasn't just about renewable energy. That was also about allowing the steel companies in Germany to do what they haven't done here, which is to really transform themselves and to lower their material content through repurpose, reuse, and recycle. That's difficult. That's high risk. It might lead to failure. So, but how you set one up in such a way that actually achieves that additionality is difficult. And I'm in a very lucky position right now to be advising a policymaker who not only listens, but then tries to get the details right, and that's Nicola Sturgeon. We told her, you really could benefit from a proper kind of Scottish National Investment Bank. She's like, all right, can you design it for me? So every week, on every Tuesday morning from 9 to 11, we sit through meetings, mainly on the phone on my end, because I'm in London, about some of the nitty-gritty on how to do this properly. Because there's many public banks that are kind of useless, including the one in my country, which is not completely useless, but Cassa Depositi e Prestiti in Italy has continued to kind of follow the general Italian model, which is about subsidies. It's kind of this it sets up a parasitical relationship between industry and the private sector and different forms of public finance. And it doesn't actually get, fiat to transform itself, or even the small Italian companies to really think about how they can engage with a sort of national, say, green or health strategy. But I think it's important just to say that there's different ways you can actually construct a public and semi-public private financial structure that achieves that patient strategic finance. And it shouldn't be about cutting and pasting, say, the KfW model, because in fact, the US doesn't have patient finance. And yet it's able to, doesn't have a public bank, but has had patient finance through all these different schemes that I talk about in the entrepreneurial state, including through procurement policy, the SBIR kind of policy. But there, the really important lesson is that by setting up these particular organizations, right, because it's not just money, these are organizations that are set up like the Small Business Innovation Research Initiative, which has been critical for providing 10, 15, 20-year patient finance to US companies, making them mission-oriented, being explicit that you're not just there to fix market failures, but actively co-shaping and co-creating something new, actually makes it really interesting to work inside these organizations. So the ability to attract top talent to work in these organizations, which then distribute these funds, is just as important as having one of these, to actually be investing. And lastly, the terminology that we use is quite striking. This notion that, again, you're just fixing a market failure, or just think of the term lender of last resort, which we're all kind of used to thinking in terms of central banks. What I've been talking about here is investor of first resort. What the state has actually done in Silicon Valley, in Israel, in Germany's energy event policy, in China today, in Denmark, which is a tiny little country, which today is the #1 provider of high-tech green services to China's green economy, and China's spending 1.7 trillion, is having had this kind of investor first resort mentality across different organizations. How you do it, it's hard. But it can be done.
Martin, what Mariana seems to be setting out is a kind of different role from the state from the one that we've thought of for the last probably 30 years of economic policy, a more interventionist, a more mission-driven, setting direction, as Mariana puts it, as well as simply trying to manage the overall growth rate. Do you see this, do you agree? Do you think that we do need a different role from the state? And do you see this as potentially a fundamental reform of our approach to economic policy in the way that the Commission is suggesting we need? Is this a moment of significant change that is needed now?
Well, my first reaction is, I always start with these things, probably it's a terrible fault of a journalist, I always start skeptical. So I always ask myself, why is this not going to work? It's what any government will do. Let me define what I think, how I understand what Mariana is saying and how it fits into how I think about this. If I understand what she is saying, it is that we should have institutions which are public. They might not be, but let's assume for the moment they are public, which have the capacity to make selective and targeted interventions in the economy. So they're not going to try and run the whole economy. They're not going to interfere in every part of the economy. They're not going to have a plan for every part of the economy. They are going to be quite targeted and selected. How you target and select is a very interesting question. And the institutions that she envisages will have a very high level of autonomy and a very, very high level of professional expertise, which allows them to be, and I think of the American examples, in significant measure depoliticized, by which I simply mean that politicians aren't saying daily what they should do. And that we have had examples of this in the past. We did in the 70s, actually, the entity that created INMOS, for example, from which a lot flowed. So I have no problem with trying that. It probably wouldn't involve colossal quantities of money. And if the institutions have the right professional competence, the right autonomy, it's clear what they're trying to do. Every country has a different context. I think it is well worth trying that. As she implied, there are many, many experiences with development banks around the world. Believe it or not, once, God, nearly 50 years ago, 45 years ago, I worked in the development bank department of the World Bank, and we financed an awful lot of them. No, it wasn't the IFC, it was DFCs. Right. And the answer was, some of them were superb. This is admittedly in developing countries. It's a different context from ours. So the Korean Development Bank was, as you might expect, a pretty impressive institution. The BNDES in Brazil has been sort of one trauma after another. Not always, by the way. It has had some good examples, but what it's done recently has been colossally problematic. There are lots in between. Interestingly, the Indians were reasonably successful with theirs at one stage. So, but We know roughly what is needed to make those work in that context. It's obviously more difficult in a developed country because you're on the frontier. It's not quite so easy to learn from what others are doing. And unlike the US, it seems to me, the US can reasonably try to have a go at being on the frontier of every available technology. We can't. We have to be selective. So set up in the right way, Mariana may disagree with that, but I think this very strongly. So set up in the right way, with proper institutional focus, this is worth trying. I would stress, however, not let us get away from what I think is a very, very important part of your report, which I think Mariana would agree with, and I think is, I haven't yet completely got to where I end up on this. But it does seem to me we have a very, very profound corporate governance failure in the structure of our corporate sector, and that won't be fixed by this. So we have to think about how you would, and I'm looking forward to your answer to this, how you would change that. I also think that the British banking sector, unlike, for example, in the old history, the German one, has never played the role of, never at any stage in our history, been the provider of new capital for new business. It's never been what it's done, and I don't think there's much hope that it will ever do that. It can be probably less damaging than it's been. So that, I think, would reinforce the argument for trying this. But we have to be very careful about how we said, what worries me, and here I think I'm very much on Mariana's wavelength. It's pretty banal, but in this case, the devil really is in the detail. You can do these things very well, and it's incredibly easy to do them very, very badly. And doing them well is going to be much more difficult than doing them badly. It's always easier to do things badly.
The other role of the state, which has disappeared largely over recent years, is proactive fiscal management. And I want to come back, Martin, to the point that you raised earlier, that you've been a critic of the, let's call it the combination of fiscal and monetary policy that has emerged over the last 7 years since the crash. Perhaps you could just explain why you think this has been wrong, and given that we've got a budget coming up next week, what you think a reorientation of the combination of fiscal and monetary policy.
My view was, and it's probably more macro than micro, but it fits in with what we're saying. Because of the analysis I had before the crisis, which has sort of become to some degree conventional wisdom. By the way, let me say, well, I understood the macro trend. I never forecast a crisis on this scale. I always say this. Nonetheless, it was clear it couldn't go on as it was. It seemed to me, and this is a point on which why Larry's coming to this is sort of interesting, because we had quite a few arguments around 2008, 9, 10, when in the US, we never had a serious argument about it here. In the US, the Obama administration came in with a view of all of them except Christina Roma, to her credit, that this would be a very quick recession. And implicitly, that's what George Osborne and the others thought. I thought we would find ourselves in a quote-unquote savings glut, ultra-low real interest rates, and very weak demand for a very long time. I had no idea how long it would be. It seemed to me likely that it would be for a very long time. That would imply that demand would be weak and real interest rates would be very, very low. And my argument was then that clearly fiscal policy had a role, and one, and two, there simply could never be a better environment in which to undertake large-scale long-term investment programs. Because they were going to be essentially free. I mean, if the real interest rate is zero, actually it's been negative, but never mind, let's assume it's zero, you can borrow for 30 years at zero real rates. It really shows a stunning lack of imagination to think you can't find investments that will return. So what we actually did when we went into the crisis, and to be fair, I'd like to be fair to George on this one, it was under Alistair Darling, we slashed public investment right at the beginning. The first thing they did was slash public investment when they should have doubled it. If they'd raised public investment, no, you'd have had to build up the pipeline, Of course, it takes time, but I thought it was perfectly reasonable because it was going to be a 10, 15-year process to, let's suppose we'd raise the public investment rate from 2.5% as it was before to about 5%. The infrastructure of the entire country, particularly outside London, could have been transformed. It's essentially costless. It would, as in a very important subsequent paper that Larry wrote with Brad DeLong in America, almost certainly pay for itself in returns, tax and so forth. And it was the obvious thing to do from a macro point of view. And I had no doubt whatsoever that that's what Keynes would have argued. Anyway, we lost this argument completely. But I want to stress that my view was that this was a long-term pump priming. And if we're going to run deficits for a very long time, then that's the time to use them for investment. It wasn't just short-term counter-cyclical. If you thought it was short-term counter-cyclical, investment doesn't work because the time horizons are too long. If you thought it was 10 years plus, as it has been, investment is the right way to go, and it's what we didn't do.
But shouldn't have conditions
It's
change?
much more difficult now, in my view. Now we can have a bigger argument about this. Clearly, the conditions are somewhat less favorable. The real interest rate remains very low. This is true. So that is true. But we've certainly got less, we seem to have less slack resources in the world than we do now. If we increase the fiscal deficit than we did then, if we increase the fiscal deficit substantially and there isn't a corresponding rise in savings in the domestic economy, you must assume, it's a matter of arithmetic, the current account deficit will rise. Which means the net financing from abroad will rise. And right at the moment, if I were advising the Chancellor, and we've decided not to discuss Brexit, when we are blowing ourselves up through Brexit, in my view, I apologize to those who disagree, is not the time when I would, and we already have a huge current account deficit, that I would hugely expand it. But that's, I'm open to persuasion that that's wrong. Certainly the opportunity now looks to me less golden than it did in 2009.
Do you think there's still scope, though, for given that interest rates are still very low, the Bank of England's raised them, but they're still extremely low?
If I were increasing the deficit now, I would increase it even so for investment. If they've got reasonable projects, I mean, I don't want to just throw it around. If they've got reasonable projects which they can already implement.
Mariana, do you agree that there should be more public investment at this point?
Of course there should be more public investment, but I thought the whole conversation, at least up until a minute ago, was that details matter. So first of all, I find it striking that we even talk about the deficit. Italy has had a low deficit for more than 20 years. Been lower than Germany's, but its debt to GDP has been rising significantly. That's a completely different story. And the fact, I mean, and I know, lots of us know this, but it does mean that then we should talk the right talk, which is that actually what matters are these long-term investments in precisely the areas that you began with, which I think are the correct ones, which is in those factors that increase productivity, which mean that GDP is growing in a long-run kind of growth way. So the denominator of debt to GDP is growing, versus what you've had, in both Italy, as you rightly mentioned, and the UK. I think, by the way, only Zimbabwe and Haiti have had lower productivity growth than Italy in the last 20 years, and yet it's been spending not much, again, 2 to 3%, maximum 4% deficit, not spending on all the things that increase productivity, so the denominator doesn't grow, so the ratio, in theory, can go to infinity. So then, what we've been saying is, yes, we need to have counter-cyclical government. That's kind of obvious, was obvious until after the crisis. After the crisis, we had pro-cyclical spending all over Europe. It shouldn't be, even when we finally wake up, as the IMF finally said, actually all this austerity has been self-defeating. And then they said, let's spend on infrastructure. That's like this panacea, which really kind of avoids the point, which Keynes sort of talked about. This isn't about digging ditches and filling them up again. That gives you a short-run multiplier. This is actually about having a plan. And if you read the end of Laissez-faire carefully, he says, the whole point of government is not just to tinker on the edges and make things a little bit better, a little bit worse through counter-cyclical policies. It's really to do what's not being done. And the question of what's not being done, what are these new areas of investment opportunities for both public, private, increasingly, by the way, third sector, voluntary organizations, if you look at the kind of Gates Foundation financing. What's interesting is that if you get that right, then actually, once you do the QE, that money doesn't do what it's currently doing, which is just ending up back in the banks. right? It actually finds its way back into the economy because you've created those opportunities. So being counter-cyclical, investing, but with a direction that is focused on creating new growth opportunities in new markets, ideally with societal challenges being the goal. And by the way, these SDGs we have do actually present us the opportunity to, if we're serious about them, there's more than 100 countries that have signed up to them, to direct these investments in ways that actually achieve those, or the grand challenges, et cetera. This isn't just for the climate, this is also about creating opportunities which then drive business investment and get all this money creation to be in the real economy instead of in the banks.
And presumably that's what you'd like to see in the industrial strategy that the government's
so,
coming out with. That is the kind of purpose for the industrial strategy. That
so what I've been trying to, and actually I think, I mean, we'll see, but they've at least been saying that they're listening, and even the challenge funds they come up with, they credited us for having focused on that, which was don't focus on sectors, especially in a country where you have low investment, where you have pretty problematic types of behaviors in different sectors. Focus on problems, missions. By the way, the word challenge is not a mission. Challenges are like inequality, climate change. They allow people to talk about it, but it's kind of blah, blah, blah. Missions are very specific ways to transform those challenges into problems that over a 5 to 10 year period, you can also monitor whether you're kind of close to getting there or not. So going to the moon, they knew when they got there. That's a classic mission. And going to the moon, by the way, one might say, fine, that was like, you know, the Cold War stuff. But what was interesting is that it took about 12 different sectors to get to the moon, including clothing. Lots of homework problems, about 100 homework problems to get there. So how you actually kind of set a direction, use societal challenges, you know, for that, but frame it as a problem that then gets lots of different sectors, and the few businesses in those sectors that are willing, so pick the willing, don't pick the winners, to engage with these kind of interesting public programs, that's transformational. And that also then lends more easily to reward, you know, kind of long-term behavior or interesting types of investments versus just pretending that this is all about kind of just spraying different types of public support across all sorts of businesses. So mission-oriented industrial strategy around green and care, specific problems that get us there, I think would be fantastic for this country.
You'll be pleased to know that the Commission, that IPPR is producing a report on industrial strategy for the Commission, which remarkably says some very similar things. We have been reading Mariana's work too. I want to open this up now to the audience. We've got about a quarter of an hour left. I didn't want to have this conversation about Brexit, but if you want to ask about that, I don't think we're going to be able to stop you. But there may be other things. We didn't cover the technological changes and so on. So perhaps we can get a few questions and we can get some answers, I hope, from the panel. So this gentleman down here with his hand up here, if you can do that. And then two on the aisle here, these two gentlemen here. If there are any women who want to ask a question, you'll be next. Yeah.
Hi there, Oliver Rice. So you touched upon state support for the provision of patient capital. I wondered what your thoughts were on the impact of the banking union, the European Union's banking union, on banks' provision of patient capital, particularly in it being a one-size-fits-all regulatory framework applied across the Eurozone banking sector and has levelled potentially some national regulation which did support and provide and was tailored towards certain banks providing and specialising in patient capital.
Okay, thank you. Gentleman there, yep. One of you has the mic, yep.
Thank you. We've been talking about the meeting today is economic justice and working for all and a good role for the state. I've heard nothing apart from one mentioned by myself earlier on today of anything about spreading more widely the ownership of capital, about anything about the redistribution of the inheritance of wealth. At the moment, thanks to the exemptions for land and business shareholdings, some people inherit billions free of tax, quite legally, and others inherit absolutely nothing at all. The proceeds of a tax on what people receive rather than what they leave could be used to give everyone a UK universal inheritance, as I've been proposing for some years. Thank you.
Thank you. Gentleman in front of you. Woman? Yep. Yep, please.
My concern is there's a gap between Apple's giant profits that Martin Wolf has so brilliantly described and what happened to them, because Apple doesn't own the profits, the shareholders of Apple own the profits, but it's the shareholders, which were the original investors, that have never been given an incentive to do what now you ask the government to do, which is reinvest in industry. And I believe that part of the reason for that, certainly here in the United Kingdom, is government changed the rules for the investment of the profits taken from industry by savings institutions. We never talk about savings institutions now, and deliberately took that as borrowings for government. So now your savings institutions take the profits in, but then give them to government because government has said we must all borrow from government bonds rather than risk it in industry. So part of your problem is you need to reconfigure the actual prospectus and the operation of what were once called savings institutions.
Great, thank you. And there's a woman there, I think, has got the mic beside you.
I'm interested to hear some ideas about what to do about homelessness and begging on the streets.
Okay. And did the gentleman here, did you want to ask one? I'm going to take one, the microphone here, please. I'm going to take one round because I'm concerned that we won't finish on time, and I'm sure all of you are keen to do that too. Please.
So I'm John Courtnage from the Occupy Economics Working Group. I happen to be a Quaker as well, so all this thing about right business is all part and parcel of my DNA. The question we asked at the Occupy Economics Working Group is, if not capitalism, then what? So could the panellists suggest an answer, or their selection of answers, to the question, if not capitalism, then what?
I will ask them to do that. And there's one, I'm going to take one more. Woman there in the middle row, if you could, yes. Just put your hand up, please.
Thank you, Janet Williamson from the TUC. I wanted to know what you thought the reasons were for very low kind of rates of lending from banks to businesses. You've talked about the low rates of investments overall, but we've also we read quite a lot in the papers about the demand for loans from businesses not being fulfilled by banks. I want to know whether you see that as a demand problem on the one side, or whether you think there's something wrong with the banking institutions, which means that those loans are not being kind of transmitted through in the normal way.
Great. Okay. So, range of questions. Several on banking, Martin, and you were on the Banking Commission, which was appointed after the financial crash, which made various recommendations, some of which have been implemented, I think, not all. Do you want to start with the point about the European Banking Union and then go on to some of the other banking questions?
I'm sure Mariana has stronger feelings about this than I do, since we are not and never will be part of the Eurozone. That's pretty clear.
And I'm
well,
Italian, so.
Never is a long time. Well, Italy is. It is clearly true, as I understand it, and I don't think this is not an area of deep expertise as far as I'm concerned, that they wish to establish a model of banking which is uniform, pretty uniform. They have created a single regulator for that purpose, and the aim is to make, clearly reduce the size of the aggregate balance sheets, which are extraordinarily large in the Eurozone, just staggeringly large, and change the nature of the assets on the balance sheet. Though the thing that they most want to reduce, as far as I can see, is the quantity of government bonds they hold on the balance sheets, which actually fits in with the savings institution issue. I do think that if they proceed in that direction, and I understand why they want to do so, it is pretty clear why they want to do so given the history, that they will have to start thinking of how to create other financial institutions which meet the development goals of these various societies. And that's not a problem that at the moment, as far as I can see, that they're really thinking about at all. And in the European context, it creates all sorts of problems around the area of state aid. I mean, that's just a fundamental issue. The second question that, do you want me to go? On the question of why are there so low rates, such low rates of lending by banks, I mean, broadly speaking, what I understand, how I think about what's happened in the UK, because that's where I focused on, We've had an absolutely gigantic increase, I mean colossal increase in the balance sheets of our banking sectors relative to the economy. They couldn't expand massively by lending to small and medium-sized business, because actually, in truth, these are always going to be on the, when we're talking about balance sheets on this scale, 2.5 times GDP domestically and about 5 globally. This would never have occurred by lending to business, and it basically occurred through the lending to households to buy properties at an increasingly inflated level. And the result of this enormous expansion of their balance sheets, which we haven't been prepared to do anything about because we don't know how we deal with the housing market. I'll deal with that one last question and then leave the rest to Mariana. Inevitably, the business lending shrank. And the result is because it shrank so much relative to all the rest, and it therefore generated so little profit, the banks felt and feel, on the whole, it's very costly to do it because all business loans are different. They're not standardizable like consumer loans or mortgage. Each one is different, very difficult to standardize. A lot of them are very troublesome. And so they'd rather not bother about this too much. And that's what I think has happened. The final element is we were asked to do only one thing in our, just on the Independent Commission on Banking, we were asked to create a banking system which wouldn't fail so catastrophically again. That was essentially the challenge. That was difficult enough, I should say. I'm not claiming for a moment that the banking sector that emerged from our report will be the one that one would want in the long term. I think we've ended up with a very unfortunate situation where 5 banks basically dominate all lending, and they have the problems we've said. Finally, on homelessness, there are so many other things to be said, but I don't want to go into everything. On homelessness, well, there are 2 problems in the British housing market, at least, which we have to fix. First, we're clearly going to have to expand supply of housing very, very substantially. There's no doubt about that. And secondly, it's also pretty clear by now, it's not something I thought 30 years ago, so I was wrong. We're going to have to increase a municipal or council or some such housing a great deal so that it can be targeted at people who are never going to be in the market. Even when we've enormously expanded supply, will be in the market. Those 2 things have to be done. Unfortunately, we have failed to do this for so long that by now, in my view, in the crucial parts of the country, the shortage is so severe that it's really very, very difficult to fix this quickly.
Mariana, I'm sorry you haven't got too much longer, but maybe wealth
I'll just keep talking.
Fix the rest.
Wealth and capital ownership.
So can I just say, the taxing the wealth issue, we didn't talk about it, but Piketty did us all a great service of writing a whole book on that, and that was his conclusion. I think that it has to be complemented by another understanding, which is the broader notion of rent, the kind of classical political economy notion of rent, where, by the way, Adam Smith, his notion of the free market was free from rent. If we really understood what that means, so much rent seeking and actual rents come from the wrong theory of wealth, where wealth comes from. So where I thought Piketty fell short was he kind of just took for, allowed for there to just remain this existing notion of who the wealth creators are, and then said we have to tax certain forms of the wealth. Fine, but if you look at what's happened to capital gains tax, if you look at the patent box policy, which I think in this country has been the manifestation of the biggest kind of rent-seeking type of policy, if you want, I can tell you privately why later, but it's a really stupid policy that rewards a 20-year, patents are already 20-year monopolies. You don't, as a policymaker, reduce the profits from a 20-year monopoly. That's already taken care of. Sorry, reduce the tax on those profits. You do whatever you can to increase the investments that create those patents in the first place. You could go down the line and see all sorts of different policies which have actually simply increased profits and, in the worst case, increased the rent part of the profits. And they came from particular lobbies and lobbying and stories and discourses and narratives of where wealth creation comes from. That is so much harder than just simply taxing the wealth. But the 2 things have to happen together. The problem is that when you do have all these regressive policies, which have been lobbied for through wrong stories of wealth, that reduces the amount of money that governments have. And it's the crime of the century that then we end up cutting, access to mental health resources, after school programs. I live in Camden with 4 children who all go to state schools. I can tell you almost all the kind of youth clubs and after school programs have been cut. It is a fact. My kids will have other resources. Many of their friends living on local estates, their lives have been transformed through these cruel cuts, which anyway were not, shouldn't have happened, but it's very interesting how they have been also forced into existence through these very problematic ways in which the tax revenue has fallen, from these, problematic policies. I recently had lunch with Vestager, the competition commissioner, in the European Commission. And I said to her, because lots of people say to me, oh, but to do what you talk about, to do the DARPA, to do this, that, the other, we need different sort of state aid rules. We have the European Commission hurting us. And she said, Mariana, show me where. Show me which state aid rule actually prevents you from having a public bank, a DARPA, et cetera. And the irony is, this is sort of, answering the other question about what to do with Europe. The irony is that Europe has been so much more lax and permissive in many ways than Britain in terms of actually forming these particular entities. We have decided to go our own way and make particular rules of what, for example, counts as deficit, current account spending, capital spending, that a country like Germany doesn't have. So Brexit, if anything, is going to make even harder our ability to actually form these strategic pots of finance. And completely lastly, to Janet's point, we've looked a lot at finance. It's much more a demand for finance problem. Interesting, innovative companies actually end up getting the finance they need globally. The problem is there's not enough of those companies. Why? We don't have this whole kind of ecosystem that we've been talking about. Not enough patient finance, not enough public financing of different kinds of things, not enough strategic long-term private sector investments, which then gives us too few kind of innovative investment type companies which are even demanding that kind of finance. But even with the SMEs, the top SMEs get the finance they need.
So you still won't talk any of you about the redistribution of the inheritance of wealth in the next
If you...
Oh, no, that's what I said. I thought, to be honest, I would have nothing more to say than what Piketty has said. He said we absolutely need exactly what you've said.
And if you look at the...
And I agree with it,
If you look at the discussion paper which IPPR produced last month on wealth, on the analysis of the distribution of wealth, you'll see that we are moving towards some proposals in that field. So do look out for that. I'm not going to ask...
on that, you need a universal, it's not inheritance, you need a universal gift tax accumulated over a lifetime. And you have to scrap the inheritance tax as it is now because it's completely useless. And I think, completely voluntary. But that is easily fixable if you have a completely revolutionary government. Maybe we will.
Well, you may well find that that idea is also one of the ones that the Commission comes up with. I'm not going to ask you both to talk about whether this is capitalism or not capitalism. We've already had an hour of your time and the audience's time, and I suspect that would be at least another one. So, with all due respect, I'm going to call this to a halt. That was a fascinating discussion. Thank you both, Martin Wolf and Mariana Mazzucato.
Thank you.